Hi, I'm Raghav Bihani from Raghav Bihani Equity Research, and in this video I'll tell you about 5 important ratios which you should check before investing. We are going to look at short-term liquidity ratios, long-term solvency ratios, and return ratios. Now before we proceed to the ratios, just keep in mind that you should ideally look at 3 years movement before judging the performance of the management or the efficiency of the ratios. Never look at 1 years of ratio in isolation. Liquidity ratios. We look at current and quick ratios which are quite similar in calculation. The current ratio considers current assets and current liabilities. Current assets are assets which are held to be disposed of within the next 12 months. Similarly, current liabilities are liabilities which are to be paid off within the next 12 months. Now, current ratio shows us short-term liquidity. It shows off that if current liabilities are to be paid off immediately, that is maybe within the next 12 months, are current assets sufficient enough to be sold and the cash proceed from the sale, can they cover the current liabilities or not? Now, how many times do current assets cover the current liabilities is depicted by the formula current assets divided by current liability. Consider company A which has 500,000 of current assets and 250,000 worth of current liabilities. It has a current ratio of 2, that is the current assets are 2 times the current liabilities. Similarly, B Limited, which has a current asset of 750,000 and a current liability of 1.5 million, enjoys a current ratio of 0.5. Now keep in mind that though the thumb rule goes by saying that any current ratio below 1 shows short-term liquidity problems and a current ratio above 1 shows that the company enjoys considerable liquidity, may not be true always. Reliance Industries has current assets of 92,538 crores and current liabilities of 1,25,033 crores. It has a current ratio of 0.4. Inox Wind has current assets of 3,359 crores and current liabilities of 2,410 crores, which means that it has a current ratio of 1.39. This does not mean that Inox Wind's short-term liquidity is better than Reliance Industries. Quick ratio is a modification of current ratio because it doesn't consider inventory. It reflects short-term liquidity. It shows us that how many times do the quick assets cover the current liabilities. Now, quick ratio assumes that the company cannot dispose of its inventory immediately, or maybe in few conditions that the inventory, if to be sold off immediately, has no value. Quick asset is nothing but current assets minus inventory. A Limited has current assets of 500,000 which includes an inventory of 300,000. This brings down the quick assets to 200,000 against a current liability of 250,000. So the quick ratio is 200,000 divided by 250,000, which works out to 0.8. Similarly, B Limited has current assets of 750,000 and inventory of 250,000. This brings down the quick assets to 500,000 against a current liability of 1.5 million. This means that B Limited's quick ratio is 500,000 divided by 1.5 million, which is 0.33. Now keep in mind, inventory liquidity varies from company to company. Companies like BHEL, L&T, Inox Wind and other heavy equipment manufacturers cannot clear inventory at short notice due to critical and specialized nature, while retail companies like D-Mart, PC Jewelers, Future Retail, Manpasand Beverages, etc. can clear inventory fast through clearance sale, discounts and other such events. Solvency ratios. We look at debt to equity ratio to judge the long-term solvency of a company. Debt to equity ratio is quite simple in calculation. It is nothing but total debt divided by shareholders' equity. It takes into account long-term debt. However, some investors also consider short-term debt. Usually, low debt to equity ratio is taken as a positive, while high debt to equity ratio shows that the company faces the risk of bankruptcy if and when the economy goes into a downturn. A Limited has shareholders equity of 500,000 against long-term debt of 1.5 million. This means that its debt to equity ratio is 3. 1.5 million divided by 500,000. Similarly, B Limited has long-term debt of 250,000 against a shareholders equity of 500,000. This means that its debt to equity ratio is 0.5. Keep in mind, this is not useful for financial services companies like banks, NBFCs, etc. Because these companies are borrowing a lot of money through bonds, debentures, and other such mediums and lending it out at higher rates of returns. Debt helps boost up return on equity for shareholders. So for some companies, having leverage on their balance sheet might actually be good for the shareholders. Also, the interest payment reduces your tax burden. Look at other factors such as cash, interest coverage ratio, etc. Let's say that a company has around 10 crores of interest payments to be made on its long-term debt. However, the company is generating 700 or 800 crores of operating profits, which means that the interests are a very small portion of their operating profits. Look out for companies generating cash from operations and using this cash from operations to repay debt. These are your future multi-baggers. Return ratios. We look at return on assets and we'll also look at return on capital employed. Return on assets basically reflects the management's efficiency in utilizing assets. It varies from industry to industry. Now, a bank and a steel company cannot be compared for the return on assets. However, you can definitely compare company in the same industry, that is pure analysis, to judge which company is more efficient. Let's take the example of A Limited and B Limited, which operate in the same industry and which generate the same net income of 100,000. A Limited generates 100,000 by deploying 2 million worth of assets in business, while B Limited generates 100,000 of net income by deploying 1 million of total assets. Now A Limited's return on assets is 100,000 divided by 2 million, which is 5%. B Limited generates 100,000 on 1 million of assets, which is a return on assets of 10%. Now keep in mind that some intelligent companies push up their asset turnover ratios to increase revenues and profits and thus killing competition. In such a scenario, you might see lowering return on assets. Very useful for housing finance companies, banks, etc. Now price to book ratio is very important when looking at banking companies, housing finance companies. So return on assets looked along with price to book ratio can definitely help you select the best company to invest in from the industry. In economic downturn cycles, look out for asset heavy companies that are efficient with their asset utilization. Let's say two steel companies are operating in the same geographies and that region is facing some recession in the steel industry. Now look out for a company which is earning higher return on assets because this company might be performing better when the economy picks up. Return on capital. It reflects the management's efficiency in utilizing assets or the capital which it employs in business. This varies from industry to industry. It helps check if the company is more efficient than its peers in the industry, similar to the return on assets ratio. The EBIT is divided by the capital employed to give the return on capital. Let's consider A Limited, which in 2016 made an EBIT of 240,000 on a capital employed of 2 million, thereby generating a return on capital of 12%. In 2017, it made an EBIT of 250,000 by now deploying capital of 2.5 million. The return on capital is now just 10%, which means that the return on capital has gone down from 12% to 10%. Keep in mind, return on capital employed is a strong indicator of moats. Value investors always take note of return on capital employed to judge the strength of a moat and its sustainability. Return on capital employed should be considered over a long period of time. You should at least look at 3 years, 5 years or 10 years of return on capital employed movement to take better decisions. Return on capital employed can be misleading due to poor quality of profits or use of leased equipments. We hope this video helps you take better financial and investment decisions. If you like this video, please like, share and subscribe to our channel. And yes, keep watching for more such videos.